Welcome to Options Trading University. We are discussing the fundamental principles of options, what kind of options there are and how they function. This is about put options. As with calls, they're brothers. And by the way, in the early listing phase of options, there were no puts. I think that between 1972 and 1979, there were only calls traded on the CBOE. Puts came at that point, and then they were widely disseminated and widely used. So we're going to talk about puts now. And what is a put? A put is the mirror image of a call. So you can see on the Spread Hunter screen here, which is our exclusive platform, that this put, the 258 put, gives you the right to sell. If you buy the put, it gives you the right to sell the underlying, which in this case is the SPY, at that strike price, 258. So if the SPY drops to 250 and you bought this option for $1.08, you could sell it to someone at 258 minus what you paid. As with calls, there are three types of puts. Intrinsic value puts, which, again, the mirror image of calls. Intrinsic value of a put is a price higher than the price of the underlying. And an extrinsic value put, an out-of-the-money put, is a put below the value of the underlying. In this case, we're talking about the SPYs at 258. So you can see that the 260 puts are 220, the 256 puts are 246. Why is that? Because of the same reason with the calls. It's one option has intrinsic value, the other one has extrinsic value, exclusively extrinsic value. Extrinsic value means it's all premium. And in the case of the 256 put, because it's out of the money, it's got 45 cents worth of premium. And if it were to expire today, if we look at today's expiration, you can see that it doesn't have, it's down to 17 cents and it's well on its way to zero at the end of the day because it will have no intrinsic value. On the other hand, the 260 put has about $1.70's worth of intrinsic value, is measured against the premium of the 260 call. So you would take this 10 cents away from this 173 and you would get the intrinsic value of the underlying. In this case, as you can see, it's fluctuating at 240, 258, 42, 39, 41, whatever it is. And the options will reflect that. But the key thing to remember is that at the money here, 58, on the put side, the call side's a little different. And by the way, the call side is gaining intrinsic value and losing some of this extrinsic premium. But this is a very important principle for options pricing. And you must understand it. You need to get out a pad and paper and start doing these calculations in your head or on a paper grid so that you can understand what you're looking at. Again, we have the deltas here showing you the at-the-money put relative to the call is 32 cents, showing you that it's have a lesser value than the call, which is 68 cents. But again, this 68 delta is showing you that it has 40 cents of intrinsic value. If this thing were to drop down to 58, both of these options would be about the same price, and both of these deltas would be around 50. So that's what you need to know, puts versus calls at the fundamental level. And by the way, we only trade puts from the long side. It's very difficult, but if you do it and you're successful, it's incredibly rewarding. And it has the same value as a call, although it doesn't have an infinite value because the underlying can only go to zero. On the call side, the underlying can go to infinity, and so, you could profit at a level that you probably can't imagine. But we'll leave that for other kinds of speculation. So that's puts in the SPYs, and we're going to leave it at that. Thank you.